Hello, fellow real estate enthusiasts. I'm Richard Montano, your host of the Loudest Silent Partner, the ultimate podcast for savvy investors who want to diversify their portfolio with passive investment opportunities. Join me as we unravel the secrets of successful real estate investing, where knowledge meets profit. Whether you're a seasoned pro or just starting, we've got insights, news, and inspiring stories you need. Let's turn the page on your real estate investment journey together. This is the Loudest Silent Partner, where your investments speak volumes. All right, so thank you for joining us on my podcast. It's great to have you here, Travis. You and I have lots of great conversations, and I think you're such a great human being. Obviously, you're from my alma mater, so Pepperdine. I think you're good people. You're my people. But it just so happens you got into the real estate business not too long after college, and which is where you and I really connect on a business element. So you started out at Pepperdine with a degree in economics and advertising. You did a bunch of startups, and then you made your way into real estate. I'd really love to know how you did that.
Yeah. I'm stoked to be here. Thanks for having me. So I grew up in construction. My father's a general contractor here in San Diego. And so I did odd jobs with him. I did a bunch of finished work. So I grew up around it, fixing up houses and stuff with him to make a little bit of extra cash. And I think when I was doing sales and startups, I was listening to some books and things on tape while driving around Los Angeles. And one of them was Rich Dad Poor Dad, which I think is the story that a lot of real estate investors is kind of a turning point for them.
Right.
So that was pretty shortly after college, and I knew that I liked real estate just from my upbringing. And so that was always kind of in the background of like, I want to own real estate. I want to own some rentals, but I never thought of it as like, this is going to be my career. It was, I'm going to buy one house and I'm going to fix it up. And then I'm going to, move to the next house and then keep that one as a rental. So it started in 2016. My wife and I had moved back to San Diego. We were able to find a condo with an ocean view that was a short sale at the time. And it was funny because we had been looking at a bunch of nice places and all that. And then we walked into this place and it was like bright blue carpets. It was, kind of boxed in a little bit, but it had a great ocean view. And it was like a flip of a switch. Both of us were like, this is the one. We called our agent like right away. We put an offer that day. And so we did a complete gut, did all the work myself. My father helped me a little bit. But did the sweat equity, play of just, we gutted the entire thing. We lived in it, for a short period of time. And then we ended up moving up to Washington. But we rented it out. We still have it as a rental. And it's been great. And so we did that a couple times as kind of, we're going to do sort of that Burr method of, we bought it, we rehabbed it. And then we did a cash out refinance and we were able to pull out all of our cash that we put into it. So then, it was an infinite return at that point.
That's right.
So,
and then you were hooked, right?
And then I was hooked. Yeah.
So you go to the next one. And yeah, it's interesting. I think there's a similar story with a lot of different people. Mine is also very similar with, my stepdad. He was a fireman and he just bought and then just, fixed it up, rented it out, bought another one, fixed it up, rented it out, and that afforded me a decent like youth, like in my, when I growing up. And so he always told me there's no more real investment than real estate. And, even though I went to college for physics and aerospace engineering, I was always in the back of my mind, like you, I'm going to buy, rental property. I'm going to buy a home, maybe move into it, fix it up as I live there. Then I'll rent it out and move to the next one. And as my family grows, I'll expand and go bigger and bigger. Yeah. And that's exactly, my same story. So I love that. And I love that you have a passion behind it as well. So you have a passion that comes from like your faith. I know that. Yep. I know that, from our conversations, about your spirituality. And now you go from doing well for yourself, creating value and wealth for your family, your legacy. Then you go into starting a fund, impact fund that has now been rebranded as Rooted. where you are buying single family homes and then renting those out for sober living.
Yep.
So I'd love to know more about that, because that, to me, that's really exciting, because I think that connects a lot of like the investment elements of it, as well as like personal development and service.
Yep. Yeah. So after we moved to Washington, I felt like the market was kind of high at the time, but I wanted to start learning about the market. I wasn't necessarily ready to jump in and start investing, but I wanted to know around me. And at the time, I really only saw real estate investing as something that I can do within my geographical range. Like I hadn't even thought about investing out of state. So I wanted to be an expert on it before I jumped in. And that's where I kind of stumbled upon this sober living structure when I wasn't necessarily looking to buy anything, but when I was presented with the numbers through my now partner and good friend Jared Galdi, we ended up jumping on this first sober living house that was in Marysville, Washington, pretty close to where I was, and it was $586,000, and we were getting a 5-year lease signed at $5,800 before we even closed. So it was like,
wow,
run the numbers.
Yeah.
This is great. It's no brainer. Let's do due diligence. Like, are they going to actually be able to pay this? What is the structure? Is the house going to get destroyed? It all checked out. So we ended up buying that house in summer of 19, and it worked great. And we continued to get to know the organization. And that was in July of 19. In September, we closed on 6 more. And that's just the way that my mind works, is like, if it works, how do we scale it?
Yep.
And so then it kind of shifted gears. It was like, okay, I got to focus on this. And at that time we were like, friends, family, like, where can we get some capital just to close on these things? And we were, drinking through a fire hose, like trying to figure out asset-based loans and different structures, how we can set up entities. I had never bought in properties through an entity before.
Right.
And so that was all figuring that out. We ended up buying 10 houses in 6 months before COVID hit. Kind of hit our cap on the amount of money that we could get from people.
Was that with the fund, or were you guys buying individual deals with each of the investors?
It was my own capital, and it was friends and family.
Okay.
And it was we owned 100% of it. It was just debt.
Yeah.
So, mother-in-law gives us $100,000.
Yep.
All right, great. We can go buy another house. It was a lot of that shifting and trying to make it work. So we got 10 houses in 4 states. And that was our case study. And they were all cash flowing. They were all paying rent. We had, very little issues. And so COVID hit, we took a pause. We kind of reassessed, but we were like, okay, they're still paying rent. These are still working. COVID's not going to shut things down. We need to figure out how to keep doing this. And so that's when we explored doing a full-on fund. And so we went out and we raised a couple $1 million from investors in early 21. We had sort of started to buy properties at the end of 2020, and then we transferred some of those into the fund. But between the end of 2020 and the end of 2021, we ended up buying 26 houses into that fund. And so we hit the gas again. And at that point we were in 11 states. So we kind of went wherever the organization needed houses. And part of that for us to be able to scale was we saw it as, it's not just a numbers game. It's a relationship business. Yeah.
And I had a question for that. It was the tenant or the client that you're working with, was that the same organization for each of the properties, or did you actually gain a few other organizations?
Yeah. So now we work with multiple organizations, but at the time we were working with the one main one. It's called Oxford House. And they're a national nonprofit. So they're in, I believe, just about every state. And they've been around for, I think, close to 47 years now. So they're longstanding. They've gone through Supreme Court cases to where they've justified like their structure. Because one of the challenges with sober living is a lot of communities and municipalities say that you can't have more than a certain number of unrelated individuals living in a home. Under their structure, they can kind of bypass that. And so that's something that they've pushed on over the years, and they've always won. They've never lost any cases against municipalities to kind of try to enforce those rules. So that gave us the confidence to continue to buy with them. And so they've been perfect partners for us, and we've kind of gone where they needed us. But we like, a common saying that we like to say is we're unemotional about the numbers so that we can be emotional about the people, because we care about them. We're trying to, get people off the streets and into these houses, and there's such a need for them. But on our end, we're not just these rich guys that have a bunch of money just to throw at houses.
Right.
We have to go out and we have to raise capital, and we have to return money to investors. And because of that, we have to hit a certain cash on cash return. And if we do that, we hit that number, we can just keep going. And so that's been our kind of philosophy from the beginning.
Then it's a win-win-win. Right. Investors are getting a return, you guys are earning, and there's a home for these individuals that need a sober living home. I love it. I love it. It's like a combination of all the good things that, we want to do in life, right? Like, again, I always go back to legacy and like building up for our families. Obviously, me coming from nothing, it's like I think about what I'm building, not just cash wise, but like knowledge wise, that I can pass on to my children so that they can also do the same thing, and, continuing to lift each other, me lift them lift their kids, et cetera. So, connecting all of that, like with good service like this, I think it's amazing. Like if we can pivot a little bit onto the idea of the investors. So you go from individual investors, helping you buy these onesie twosies. And then you have a fund. And then that fund actually closed, and you now work with just one or two investors. So can you talk about how you like transition from one to the next, these three phases that you went through with Rooted?
So with the fund that we launched, and we bought those 26 houses, we had, with any fund, you set the terms, there's fees, there's splits, there's, all of that. And then you're, targeting a specific cash on cash return. Well, in 2022, housing prices, were shooting up, interest rates were starting to come up, and the cash on cash was getting suppressed a lot. And it got to a point where we were like, we can't just keep buying under this structure and without bringing down the average of the overall fund. And so we talked to our investors, and we're like, we're gonna stop here. We might pick it back up later, but in the current market, it doesn't make sense for us to just keep buying. And I think that's, something that, some syndicators, might not, they want to just keep growing. But for us, like, we saw this as just the beginning, and we wanted to continue to perform for investors, not just force new properties that didn't make as much sense. And so we shut that off. We took a pause. And then we just last year started a new structure. We have one capital partner currently, who's it's less of a fund, it's more of a just syndication, but this capital partner brings all the money. My partner and I, Jared, we deploy all the capital, we manage the properties, we get all the leases in place, we do all that, and we have a good split structure there.
Yeah, so I think that's a testament to your ethics too, because I've seen other syndicators in a similar situation. They'll just drive the bus into a wall, right? They're going to go until the returns are bad, till the investors aren't happy, until they get stopped, and someone stops them because they're just trying to collect fees. Right. And where your focus was, how do I want to treat my investors well. And this is what needs to be done to do that. And so I love that. So you pause the fund or you close the fund? Just curious.
I mean, it's still open-ended. Like, we could pick it back up, but we haven't bought in anything since the end of 2021.
Okay.
So, yeah.
So,
and investors are like, they still ask us like, hey, can we buy some more? Like, we want to deploy more cash, which is good. It's great to, have them, always asking for more.
That's exactly it. Right. Because, you left them wanting more, right? Because you did the right thing, right? And we see that on a lot of our deals too, where we've tried to treat our clients the best way we can. Obviously different circumstances happen. We went through COVID, and rental properties were a little difficult at that time, but we did the best we could with our clients, aka investors, in mind first.
Yep.
So, and typically in our structures, I'm paid last actually.
Yeah.
And you go down the tier, it's like all the way down at the very bottom, there's Rich, then he gets paid. So if things don't go great, I actually don't get anything.
Yeah.
So that's different. So, I work with investors on a regular basis. I've done that since 2009. I've had, tons and tons of investors. Can you share how you feel about working with the different investors at the beginning, which seems like it was friends and family, and then like different elements of how you operated the fund and how you interacted with investors, so investor relations.
Yep.
And then I'd love to know, like, were there any benefits to either of those three options that you kind of went down? Like, which ones do you prefer? Is it a timing thing, or what is it that if you had everything you wanted, what would you do?
Yeah. I think, from my perspective, there's pros and cons. So debt is always great because then the expectations are really simple. Like, hey, you give me $100,000, I'm going to pay you an 8% return.
Yep.
You know exactly what you're getting. There's no, gray area. I know exactly what I got to make. And so that works really well. It's not as easy to raise debt, especially, beyond a certain limit. So, I've done a good amount of that as well. And I own properties where I've just gotten debt from people who are like, hey, I've got this retirement, entity that I'm good with 8%, for years. And that's perfect. But it's not easy to continue to raise that. If you can, and you're confident about your numbers, I would say debt is a great way to go. But if you're trying to raise more capital, then you most likely need to come up with a structure where you're giving up equity. And usually it's a larger chunk of equity that goes to the investor as opposed to the operator.
Right.
With that, there's different types of investors. There's people who are just investing in their first deal or first couple deals, and they sort of want to be hands-on. They want to be the operator themselves, and they want to learn from it. And it's okay if they're just curious, but if that's a lot of money to them and they're paying close attention and all that, then it's just gonna be more difficult because they're going to kind of judge you on every decision that you make. And ultimately for investors, you want to pick the right person before the deal.
Yes.
And I think that's super important because, you could have the perfect, commercial property, multifamily property that has all the numbers laid out. But if the operator is not the right fit for that, the whole deal can go south. Even if all the numbers look perfect, it's under contract, we've got the interest rate locked in, we've got all this, doesn't matter. The operator can kill a deal.
Yeah.
And I think we're starting to see that in the large multifamily space. And a lot of it has to do with interest rates and some of these variable rates that are kind of coming to fruition in the market. But and then, like we talked about before, not willing to make a hard decision when the market changes.
Right.
And I like to stick to single family because, one, it's just what I've always done.
Yeah.
And I'm familiar with it. I am very optimistic that single family is going to continue to grow and we'll see really good appreciation. But also, it's very flexible. If one asset is not performing, we can sell that house. We can move to a different market. We're not locked in with a whole bunch of capital in one area.
Right. Yeah, that's a really good point. I think going back to your point about making hard decisions, one of the first big decisions I had to make, I think it was like 2016. I had this land just east of downtown San Diego, and we built 20 apartments, 20 condos, I should say. And they were townhomes, 2-car garages, 3 stories above, solar panels. I mean, these beautiful units. And, we started to evaluate the market right when we were close to being done. And we started looking at like what we could sell these for. And the prices that we could sell them for were somewhere like in the low 600s. And as a rental, the rents that we get for those same units would probably get us like high sixes as an apartment building.
Mm-hmm.
And so I remember sitting in a meeting and I said to a couple key investors that were there, a couple partners and some people from my team. And I said, guys, I think we have to switch to apartments. And they looked at me like I had three eyes.
Mm-hmm.
And I just said, guys, like, look at the numbers. I mean, this is what we should do. And unfortunately, this was the one and only time that I've ever had to do this. I went against my entire team and my investors.
Mm-hmm.
It was a really hard decision. And I did it. And we ended up selling the building for $700,000 a door, which was a record at that time, unheard of in that market. And I'm so glad we did, because if we didn't, we would have had a lot of headaches that would have come later. We would have had obviously a much lower price. Our investors would have gotten a much lower return. They still would have done okay, but they did great instead.
Yeah.
And so sometimes, it's like, it's tough when you have investors who don't necessarily have the same experience as you or same understanding, right?
Yeah.
Because they just have maybe like a fear. So I think you're definitely right about the operator. But going back to the investor for a minute, there have been investors where we've actually worked with, and then later, after the deal is closed and they get their money back and their return, they say, hey, what are we doing next? And then they I take them off the list. And I take them off the list for future deals because they were such a pain, unnecessary pain. I understand sometimes there's necessary conversations and hard topics to cover, and but sometimes it's not necessary. So it's like fear-based, inexperience, something to that effect. What best practices would you offer or suggest to a limited partner to be a good limited partner? And not get knocked off a riches list, and to be successful as a limited partner. What are your thoughts there?
Yeah, I mean, it's like anything. Like you want to be a good person. You don't want to be making the other person's life difficult, but you need to know the expectations. Ask as many questions as you want up front before you make the investment, and know what you're getting into. And if the operator is performing on everything that they've hit, then sit back, enjoy it. And you can ask questions, but don't micromanage.
Right.
I think that's kind of the key. So, I mean, that would be kind of the main thing. Now, if the market is going south, or the deal, you're not getting the returns that you were, expecting, find out why. And, the operator should be able to, point to, hey, this happened, things happen. So it's not always the operator's fault, but how are they going to navigate that situation and get out of it? So it's okay to ask those questions, but don't try to take it over as the operator and think that you have, more insight than they do. Because like you said, you're probably not getting paid unless it performs.
That's right.
So you have, more incentive to be trying to navigate the situation.
That's right. Yeah. And I think there's a key word you said there, which was ask questions. We've had, and this is not common, but in my last 12 years of doing business, I can probably think of 3 different individuals that either emailed or called with accusations and statements about what's happening. And I would just listen, as respectfully, as long as they were being respectful, I'd listen. And then I would suggest a few questions.
Sure.
Like here, let's find out what's actually happening versus you just like demanding or stating a fact that you're not really aware of. And one guy in particular, he just kind of made these statements like, I'm no idiot. I've been around a long time. I know how this works and blah, blah, blah. I mean, the guy, he's an accountant, retired accountant. Sorry. He's a retired accountant and a very smart and intelligent guy. But he doesn't do real estate every day. And so he has to have a little faith in me as a sponsor. And so when he showed up that way, it made it really difficult to have a conversation. We remedied it really, really, really quickly because like I've known their family for a long time. And so I gave him the information he was looking for. And then he says, oh, great. High five. Great. So I really didn't appreciate how he communicated, but it was easily corrected. In other situations, I've seen investors who are just unrealistic,
Yeah.
and they can't learn. I shouldn't say they can't learn. In that moment, they're not learning,
Yeah.
and they just keep pushing and pushing without asking questions. And so I think it's a really important one. I always say, like, I have SAQs. When someone comes to me, ask me about a deal that they're doing with someone else, I say, here's my should ask questions.
Yeah.
Right. Go into it with an open mind, go learn, be inquisitive and curious about not only the sponsor, but the deal and how they perceive the markets and what they're going to do when things go wrong.
Yep.
So that's a big one. Any other suggestions you have for investors?
I think, now, I mean, it's nice that, your podcast is focused on, passive investors, but there's a lot of podcasts, there's a lot of books education out there on how people should get into real estate investing. And I think over the past couple of decades, we've seen a big shift of people, really moving into this asset class as investors, and, part-time investors.
Right.
And I think a lot of people can own a couple properties local to them. They can manage them. They can do that well. But taking an operation to a larger scale is a different ballgame.
Yes.
It's not this, there is no passive real estate investing unless you're a limited partner. It doesn't matter.
Right.
If you have a property manager, but you own the property, it's not passive. And I think that is a misunderstanding that a lot of people have. And so I think people should really understand what they're getting into before investing. And I would say, as I've, grown my career in real estate, and I've done a couple, syndications now and stuff, a lot of people should be doing limited partner investing, passive investing, as opposed to trying to do it themselves.
Yeah.
So,
yeah, I think a lot of people don't understand that what actually has to go into it. I mean, just having the knowledge and wisdom from experience, that's one. Having resources, so like contractors, or just a simple, like a plumber who's going to be able to go address a leaking sink that a tenant brings to your attention, which they don't always bring it to your attention when it starts. They bring it to your attention when it's annoying to them, if then. And at that point, there may be water soaking back behind the cabinets and doors and stuff. So you need somebody who's going to be able to respond quickly. So I think that's one of those things. Time is another, right? A lot of my clients are accountants, doctors, dentists, people who are out there in the industry doing what they are experts at. Yeah. And they're very intelligent, very capable people. And they think because of that, they can go do active real estate investments as well. Yeah. Again, to your point, it's not passive. So I think for them to go focus on their careers and their families, their friends, their community, they can actually do passive investing with someone like us. Yep. So that was a really important aspect of why I created this podcast, because I wanted to really educate people not only in how to be a really good investor, but also to understand what it actually takes to do it. Yep. Right. This is my job every day. I literally am constantly talking to my property managers. I'm dealing with attorneys regarding the tenants, and then analyzing other deals, or even simply looking at a property and saying, okay, do I sell this? Yeah. All right. What's going on with the markets? All right. When do I have to refinance? Yep. And when I refinance, what are the guarantees required? What does the lender require? We signed loan docs for a building of ours. I want to say we closed just over a year ago. Which was great timing. Yeah. we got a really good interest rate before everything went crazy, and the loan docs were literally like an inch and a half thick. Yep. And the legalese there is really going after you, saying, okay, if you do this thing wrong, then we have, we can come after you. There are remedies for it, and so I think that's really, really important. Best practices for a sponsor. How about that?
I think being very transparent in the deal, and if anything is going south or it's not, it doesn't necessarily need to be going south, but the expectations are changing because of the market or some unforeseen event, you can have a plan, create a plan. You don't need to just go tell your LPs everything right away, but come up with a plan, tell them, hey, this is going on. this is going to affect returns, but this is what we're doing to, avoid a worse situation, or, this is a temporary, loss that we're going to have, but we're not going to do, some huge capital call and we're going to be underwater on this deal. Having that transparency and just being upfront and honest.
Yeah.
Everyone should understand that things happen. It's real property. There's hurricanes, there's tornadoes, there's, whatever. Things can happen. Insurance may or may not cover everything. There's going to be added costs. So that should be an expectation. And if you can't handle that, then you shouldn't be a limited partner in an equity deal.
Right.
You can do debt, and maybe debt is the right path for you. But if you can't handle that, then you probably shouldn't be investing as a limited partner.
Yeah.
But yeah, that would be my just advice to sponsors, just being transparent and honest.
Yep. Yeah, that's really good. We had a situation with one of our properties. I had a great business partner, phenomenal human being. He and I are still really good friends to this day. He sees everything in such a positive light, everything. And he was an inspiration to me, like to be like better and less stressed. But there were occasions where his rose-colored glasses sometimes kind of hid the bad things, right?
Yeah.
The bad things were sort of like, he's going to take care of them, and I don't have to worry kind of situation. He thought he was doing the right thing.
Yeah.
And then some of those sprouted into bigger issues.
Yep.
And then it was like, holy cow, where'd that come from? And then it was like, what else is going on, right?
Yep.
And now I have to dig and dig and dig. And so I think what happened there, and I hope, I know he learned from this as well. We both learned a lot from it, but the lack of transparency of the bad was really a detriment to our partnership.
Yep.
And in that moment, our partnership continued after that. But in that moment, it was really stressful. It actually created more stress than I've ever experienced in my entire life. Because of some of these bad things that weren't addressed. And if he had been more transparent about some of those things, we could have addressed those together openly, and instead of like trying to fix things after the fact. So that was between partners. I think that also applies, as you mentioned, to between the sponsor and the investors.
Yep.
Because I think that's just, it's got to be that way.
Yep.
And because I think the more we understand, the more we can empathize, right? Or at least have compassion for the sponsor and the investment itself.
Yep.
And then it becomes about the investment, not necessarily about the person, right? Like you don't want to attack the person. You're like, the whole situation is happening.
Yeah.
So now as I'm going to transition to this, like now you as a sponsor, you are a human being that has wants and dreams in life. And how do you believe that your sense of self, your core self, translate to you as an investor, entrepreneur, sponsor?
It's a loaded question.
It's a big one, I know.
One of the things, as we've kind of started coaching men, and we started off talking mostly about real estate and just coaching on how to get into real estate. But then what we've found is that just about every man out there, and we focus on men because that's who we are. We're fathers. My partner and I, we both have. I've got 3 sons. He's got 2 boys, and so we're trying to raise men that are followers of Christ, and that's important to us. And so we've really kind of shifted our coaching not away from real estate, because we believe everyone should have some form of real estate in their portfolio. But before we get into finances at all, we talk about you got to be right with your faith, your family, and your fitness before, and remove any blockage that's there before you can truly excel in your finances. And so those are the 4 F's that we kind of go through with that. But as we've asked a lot of people, why do you invest in real estate? We get the answer, I want to leave a legacy for my kids. I want to be able to retire early. I want to replace my W-2 income. Very few times did I ever hear, I want to get my time back.
Mm-hmm.
And that is the big trigger for me and why I invest in real estate. Because even though I'm a sponsor and I'm actively doing a lot of things, I can adjust my time and I can press the go button and I can push hard and I can acquire assets. And then there's times where I can trust my team and make sure that I've got the systems in place to manage those properties well. And although there's still active work, it's not nearly as much. And I can take time off and I can spend time with my family, because I don't care about giving a large portfolio of properties to my kids and leaving them, this mountain of wealth and legacy. What I want is to give them my time, and I want to help them build their own legacy before I'm gone. So that's something that's been sort of a epiphany for me as I've kind of dove deeper into this space.
Yeah. So I gosh, man, I'm like, you gave me chills thinking about that, because that's something, I mean, there's that old parables, give a man a fish, feed him for a day, teach a man to fish, feed him for a lifetime. And so I think about that with my kids as well. It almost, I wish I could just quote that and just repeat that over and over when I can share it with others, is that empowering our kids also empowers our communities, right? And then we can lift, which is back to my brand, we can lift a lot around us that not by physically muscling it up with our intellect and money, but by giving them the buoyancy to do it themselves. And that is like, I mean, that is just huge, man. And again, it comes with time, right? If you're an absent father, your kids aren't going to learn the difficulties you have in your work. They're not going to learn the positives and negatives of the things that you do. They're not going to get those examples from your life to learn from. You might show up every now and then and give them a list of things to learn and then leave. That they're not going to learn from that. They're going to learn by example. And so having the time with them is actually what does that. So huge proponent of that. And then secondly, like for me, I think the same way. I do want to create a base, a foundation for them, financial foundation. But at the same time, what I would love to do is be able to give that to them over my lifetime, not after I die. Right. So like one of the things that I would love to do, and I hope everything goes as planned, and I do this, I get to give them things to help them grow. So as my daughter starts her first business, I can, give her a loan even and say, here, I'm going to be your first investor. Here's a loan though. You pay it back. You got to earn it. Right. And then as she's doing it, I can be there as an advisor to, say, remember that time at dinner when I was telling you about this thing when you were 15 years old? You're kind of going through it now, and here's how we can work together to get through that. So, and so, that's a huge one, man. Well, anyway, man, I love the fact that you connect all your 4 F's with how you live. And I agree 100% with those. And I'm just, thankful that Alan introduced us some years ago and a couple years ago, I guess. And how we've gotten to know each other, and I love what you're doing. Here to support you as much as I can. I don't know if there's anything that you'd like to add before we wrap, but you're welcome to.
No, I think I appreciate our friendship, and we've been able to collaborate on deals, over the last couple of years. Alan, who you mentioned, who introduced us, is actually one of my limited partners. So, it all comes full circle there, which is cool. But yeah, happy to be here. Thanks for having me.
All right. Thanks a lot. Appreciate it.
Yep.